Good morning and welcome to Money Sense. I'm your host, Neville Hicks, alongside my co-host, Christoph Barnett.
Good morning, Neville.
Join us in studio this morning is Doug Orton, who's VP of Relationship Management for MFS. And so welcome in studio, Doug.
Great, thanks. I'm glad to be here.
Doug is down here as part of Brickay's pension plan and doing a number of seminars. So we're really thrilled to have you join us here and talk a little bit about pensions and investments. So thank you.
Great. I'm glad to be here. Any excuse to come down to Cayman's a good one.
Yeah, and from what I hear, you've been frequenting the island for the last number of years.
Yeah, my wife and I started coming down here in 97. Fell in love with the island and the diving and come down as much as we can. So having a business reason to come down, all the better.
Good.
You mean business excuse?
Exactly.
Yeah,
Exactly.
And the sun's coming out now, so I'm sure your wife's a little happier too.
Yeah, well, she's out on the dive boat without me today, so.
Okay, yeah, you're stuck with us.
Yeah.
There, go figure. Talking about retirement and investments. I guess kicking into that, we always talk about investments, but I think the critical part before we talk about investments is talking about how we actually save money to have money to invest. What as far as savings go, and when you're talking to crowds about retirement, what's kind of the message that you pass along to people?
Yeah, I think the first thing to think about it is what's your goal for the money and what are you going to do? And that drives all the other decisions. And then the second thing that I like to point out, because I do run into a lot of people who say, I don't think retirement's realistic, or I like what I'm doing, I'm just going to work forever. That might not work for most people. I know in the U.S., the statistics say it's more than a third of people are forced out of work. Mm-hmm. So they don't choose to retire. They're forced to retire due to illness or layoffs or things like that. So whether you want to have a retirement or not, the chances are you're going to. And the money that you save today will make that a much more pleasant experience. And the earlier you do it, the better off you'll be when that retirement date comes.
So, but how do I save? I'll ask it just as basic like that,
Yep.
right? I have my bills. I got my salary, and at the end of the month, I said, well, I don't really have anything left, and I didn't save anything.
Yeah,
so how do I do that?
That is a great point, and I would argue that you're doing that backwards, because for almost all of us, what we have at the end of the month always ends up to be about zero, right? What comes in and what goes out magically evens out. But think about those months where something weird happens. Your water heater goes out.
My AC wasn't working last night.
You have to have your AC fixed. Yeah. And so you have that unexpected $100 bill or $150, $200 bill. Somehow you just adapt during the month. And at the end of the month, you're still at zero. You don't end up at negative 150. So there's a concept called pay yourself first, which is just put the money in the retirement account from your paycheck rather than at the end of the month when you get paid, and it'll all work out. I've been doing retirement seminars for, 15, 20 years. And when I go back and I'll go talk to the same people, and there'll be these young people there who say, you said just put an extra 2% in and see what happens. I've never run into somebody who said, I tried it. I put an extra 2% into my retirement plan and the wheels fell off the bus and everything went terrible. But I do run into people, 10 years later, and they'll say, I can't believe how much money I have now because I started young. And for most of us, you add an extra 1% to your account. The next year, maybe bump it another 1%. Next year, bump it another 1% is an easy way to do it. You probably won't even notice it. And a couple years in, you've got a significant savings rate that can get you to your goals.
Yeah, I think another one that I've heard too is, as your wages increase with inflation, or you get a bonus or a pay rise, just look at your run rate as if that didn't happen, and everything over and above that, contribute to your investment account and put that money to work effectively.
Absolutely. You get a 3% bump, at the end of the year, beginning of the year, up your contributions into the voluntary account by 1%. You still get a raise. Your paycheck still goes up, but some of it you're paying to your future self. And it can be hard, right, to defer that into the future. But, the way investments and compounding work, the earlier you start, the better. So one of the traps people fall into is, I'll save when I'm older and I have a higher income. When I'm at my peak earning years in my late 40s or early 50s, that $1,000 you put away when you're 24 is worth way more than $5,000 or $6,000 that you save when you're 55.
I like the idea of what you said. If you get a 3% raise, put 1%. Just because mentally it's hard to say, well, I just got this raise and, oh, wait, I didn't get it because now I have to save it, right? It sounds like a chore and it sounds like a punishment. Whereas I like the idea of, well, I just got this Christmas bonus and I'm going to take a third, maybe half of it, but I still got this bonus and I get to spend it. Or I just got this raise. Oh, I still got a raise, but I put now half of the raise now I'm putting. So I like that idea.
Yeah, because, sometimes people think of saving for the future or retirement as, I have to live this miserly existence. and that's not it at all.
No AC.
Yeah.
No coffee.
Turn off the AC or you'll read things. There was an article I read that was like, use your razor a couple of extra days, all these sort of crazy things. And that's not really what it is. What it is having the best lifestyle that you can over your entire life, so that you don't have this great lifestyle while you're working and then a terrible lifestyle when you're retired. Instead, just a little bit of savings now so that you have a consistently good lifestyle and you've got cushions for when those unexpected things come up. I hate to say it, but money makes a lot of problems significantly less bad, if that makes sense. You have an emergency fund, your AC goes out, you've got the money to pay for it, no sweat. But if you're not saving anything for retirement, for emergencies, little teeny bumps can snowball into huge problems. Your car goes out, you can't get to work now, you end up taking less shifts, and you just get this big snowball downhill, and it can be hard to recover from.
I just want to repeat on a point you just made because I think it's important and useful for our audience, and that is maximizing your pleasure, your life over the long term, right? Because we all think, oh, well, what am I going to do today? And instant gratification. But think of it in terms of something that we can all relate to, eating well. So let's say today I want to have the maximum pleasure from eating. Well, if I just go and splurge on the biggest breakfast I can, eating every pastry, just eating as much. The rest of the day isn't going to be very fun. Then you can extend that to a week and so on. So if you think, how could I maximize pleasure from food? Well, it'll actually be spread out. It'll be different varieties. And you can see how if I want to maximize the pleasure, including Friday, I need to be careful what I'm doing on Monday. And so it's sort of the thinking ahead to say, I'm not cutting back. I'm just extending throughout the whole period.
Absolutely. Yeah. And there's been a lot of research on people's happiness and how it relates to money and spending. And what a lot of it is showing us is that, that last dollar of spending, or, there's a diminished returns as you spend more and more. So that shaving a little bit off the top now, you probably won't notice. But fast forward to when you're 65, if you're living on, $10,000 a year versus $30,000 a year, or whatever that number is, that makes a huge difference. So it does make sense to save enough, not that it's super painful, but do it in a slow, controlled way as you move it up over time so you don't even notice it. And then you've got money to do the fun things when you're older and retired.
Wiser.
So you mentioned 10,000, 30,000. how much do I need to save for retirement?
Well, that all
Good question.
I love that question. And that all depends on your lifestyle and your spending. For some people, so I wouldn't focus on a dollar amount. I would focus on sort of a percentage of what you're spending. And what the research has told us is, if we look at pretty much any historical period, if you save somewhere around 16% of your income, you can continue the same lifestyle throughout your life, which I know sounds like a big number. But if you think about it as, 5%'s going in from your employer, 5%'s already going in for you, that means if you do 6% voluntary contributions, you're at that number. And going from no voluntary contributions to 6 might be painful. Mm-hmm. But for a young person, the other way to look at that is, if I up it by 1% a year for the next 6 years, I'm there. And what I would stress is, if that sounds, painful, or just try it. Just up your voluntary contributions by 1% and see what happens.
Yeah.
If it doesn't work out, you can always stop making those contributions. But in my experience, a 1% extra
Increase,
expense really doesn't blow anybody's budget up.
Yeah. And I think too, we talk about young or old. It doesn't matter, I guess, is what you're saying. It's all about starting now. And I think we've spent a couple of shows talking about the power of compounding, and how much of an impact that has over time. And people oftentimes think, well, if I'm contributing to my pension plan, I'm never going to see that money ever again, because it's not there, or it's not the same as having money in a bank account. But the value that has being invested over time, we'll kind of talk a little bit more on the investment side second half of the show. But just to see that, and invest that and save that over time, regardless of age, I guess is the message that you're
Absolutely.
delivering.
And what I would point out is, my definition of old gets older every year. And I'm at the point where, when I was 24, I had a lot of difficulty envisioning myself as a 50-year-old, but now that's right around the corner. And so I think that's another point of start now, because old happens faster than you think it does. Mm-hmm. And having that balance in the account does have a significant impact on your psychology as you get older. Knowing that there's something there makes a lot of things less stressful as you approach that retirement age that I know when you're 24 seems absolutely impossibly far away. But trust me, you'll be 47 before you know it. Yeah. And then it makes a lot more sense.
Great. Well, we're going to take a quick break. We've touched on the points of saving for retirement, and we'll get into the investment side. So please stick with us with Doug Orton from MFS.
This is Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by One Trade X.
And now, more Money Sense.
Good morning and welcome back to Money Sense. I'm your host, Neville Hicks, alongside Christoph Barnett. And in studio, we have Doug Orton, VP of Business Development with MFS, and doing some pension work down here with Brooke Hay. So thank you again for joining us.
Glad to be here.
We've touched a little bit on saving. I think we're going to kind of wrap up that thought here. And Christoph brought up a good point during the break, and maybe I'll throw it over to him.
Yeah, we were talking sort of about saving in this generic sense and paying yourself first, but I just wanted to point out that there are several ways to save and sort of answer the question, where do you put it? Because now we're seeing interest rates tick up, and so if you're seeing your mortgage rate increasing, well, if you're paying extra on your mortgage, that's a form of savings, because if you have a 5% interest rate on your mortgage, in theory, you're earning 5% on that savings, which is a pretty good return. You're not going to make that in a bank account. There's also just saving up cash reserves for those emergency bills we were talking about. Is additional voluntary contributions, which can, while you think, it's going back into my pension, I can't get it out. Well, if you think about it, that can be a behavioral hack, because if you can't get the money, then it's saved for retirement. and then additional, brokerage accounts and so on that we've discussed in other shows. But I just wanted to talk about that. How am I actually saving? Where does the money actually go?
Yeah, and I think the major point is, regardless of what you're doing, less spending, more saving, ultimately for retirement or your life down the road leads to a better, more fulfillful life. And Doug, you were talking a little bit about the psychology, and which I think is interesting, and it's hard to really explain, but we all have these emotions. And a lot of what we're seeing now, certainly, or the feedback that we get in our business line of investment management is, how do we navigate this market? We're in this bull market. We've missed all this investment opportunity. We don't really know how to invest. If it goes in the pension fund, what do we do? I mean, what's your advice to someone who's looking to save for retirement when you hear those comments?
Yeah, and it's worldwide. We're all essentially the same. We have the same needs. We have the same psychology. So I get the question all over. And what I think helps is to always take a step back and think about what's my goal for the money. So if my goal for this money is, I want an emergency fund in case my car breaks down or my water heater or whatever, then that drives the investment decision to that should be in something very safe, a savings account or some other bank deposit. If the money is for retirement and that's 20 years away, and then throughout retirement, which means some of that 60-year money, then those short-term things don't really matter. Where we are in the market cycle, did I miss the bull market? Is a bear market or a down market right around the corner? Well, if you're not going to use this money for 20 years, we'll go through at least another full market cycle before the end, so you don't really need to worry about where we are in the cycle. You just pick an investment mix that's appropriate for your goal, start putting money in it, and then what I'd say is turn off the news. Don't watch the business channel. Don't, check your balance every day, because that just causes stress. Just remember, 20 years from now, there's plenty of time. All that noise is going to wash out and everything's going to be fine.
So how do I turn off the news, right? Because we see it, we get emotional. So how can I stay disciplined in spite of all this we're bombarded with fear?
Yeah, one of the things to look at is what impact will it really have on my success? And for years I told people, as you save for retirement, a down market won't impact your goals at all. And then eventually I realized I was wrong, because for someone who is investing regularly, a down market makes it significantly better in terms of whether you're going to meet your goals or not. Because if you think of investing as, what I'm doing is I'm buying future income, and I'm buying it regularly every time I get paid, a down market you should view as a sale. And if something goes on sale that we use all the time, if Foster's has a sale and Diet Coke is half off, we're like, great, I'm going to buy more Diet Coke. I'm going to buy, 2 cases instead of 1 or whatever that is. But for some reason on the investment side, we look at it differently. Mm-hmm. All of a sudden, investments go on sale, they're 30% off, and we panic, and our desire is to sell all the investments we have, which if we can force ourselves to think logically of, okay, this is a sale, maybe I should buy more. If you're able to do that, you're going to have a much better chance of meeting your goals. If you're unable to do that, then maybe the investment mix you picked was a little more aggressive than what you should have done, and maybe you want to tweak it before the downturn happens is probably your best bet.
So I want to emphasize what you said there in terms of when you own shares in a company. So you're owning a share of all the future earnings. So if you own a basket of companies, you own a share of all those future earnings. And I think what happens when we see the sale, the reason people act differently is when you think about the Coke that you have at home, when it goes on sale in the store, the Coke didn't devalue in your closet. You can still drink that and use that. Well, you can actually think of that the same way in terms of stock. Well, yeah, if you had to sell all your Coke, obviously you have to sell it at a discount. But if you're thinking, what am I going to use this Coke for? Well, if you think the earnings of the companies long term, is your share in the earnings? Did all the earnings go away? No, it's just if you had to sell it now, this is the price going down. If you had to sell all your Coke, if you're going to drink the Coke, if you're going to use the income, then it's still going to be used for that purpose. So I think that's the disconnect when people hear, oh, I love a sale. Well, but I never sell the stuff that I bought in my closet. I never go and sell my clothes back to the store. But you're going to wear your clothes. You're going to use the income from your investments.
Yeah. And one thing that can help is to look at, the dividends that the companies you own are paying out. So if you own, AT&T or Coke or Johnson & Johnson, they're paying out. The two ways you get returns from that is the price can go up of the stock itself, and you also get this dividend flow off of it. And if you look historically, when we've had really bad markets, dividends sometimes go down, but not by a lot, especially when you own a big basket of stocks and they come back very quickly. So one way to sort of trick your thinking is look at the cash flow that's coming out of these investments and focus on that, because it's a lot more stable and in a lot of ways is what you're really buying. Because to your point, it's the earnings that these companies are making that's going to drive the intrinsic value of the investment. What the market will pay for it is going to bounce all over the place. Dividend's going to be a little bit more stable. Focus on the earnings or the dividends, you get a better idea of what you really own.
And that touches on the point of the news that you're talking about, and the fear, because you don't turn on the financial media and they report today the basket of stocks globally, worldwide, the earnings remain stable and the outlook.
And you're going to get
the
your same dividend.
No, they said
inflation.
The price dropped 4%, right?
Yeah.
Because that's an exciting story. But no one says, well, the earnings are all stable, right?
Yeah. Or you'll see one day it'll be, the Dow plunged 150 points. You're like, well, that doesn't sound like a plunge. The next day it's up 150 and it'll be like, it was up 150.
Yeah, it's back up. That's it.
The negative sells more, eyeballs and ad space, and that's what they're looking for. And what the data tells us is the more you focus on those data points, the more you watch that day-to-day movement, the more likely you are to make a bad decision. And it doesn't matter what the Dow did today or what the world stock market did today. That's going to have zero impact on your lifestyle. So I would say, turn on Food Network, turn on the Travel Channel, watch something that's fun, and don't worry about it.
And I think, too, we were chatting earlier just about looking at time horizons and people, let's say you have someone who's 50 and maybe they're going to work till they're 65. So they think, my time horizon's 15 years. Maybe I should be more conservative. Well, that isn't necessarily the case. I mean, there is a big shift when they retire as far as they're not generating any income from their job. But they're not going to, hopefully not going to keel over and die when they're 66. They still have a lot of runway vis-a-vis time and risk tolerance in their portfolio. So what would you say to someone who's getting close to retirement and thinking about, now I'm not going to have an income from my job. I'm going to have to rely on my investments or be pulling money out of my pension. How do you position it with what asset classes, or thinking about risk or their ability to be able to handle, let's say, a 30% decline in the market?
And that's a great point. And to reiterate your idea that you don't have a time horizon when you think about retirement. You have many time horizons, because some money you're going to spend 15 years from now, some 20 years from now, some 25 years from now. And when you think about it that way, that if I retire at 65, I've probably got another 30 years. What we think of as safe investments are sometimes the most dangerous. If you say, okay, I'm retired, I'm going to put everything in things that can't lose money, bank deposits, bonds. Bonds can lose money, but you know what I mean. Because inflation, that's actually a very dangerous portfolio. And when the academics have looked at it, the chances of you running out of money in a 30-year period are the most in an all bond portfolio.
So going kind of ultra conservative,
Is
if you will.
yeah, we think of that as a safe portfolio, but it's actually the most risky.
Or putting all your money in a bank deposit, for instance.
Because you figure, think about what money was worth 30 years ago. If you had $1 in 1980,
how many Diet Cokes could you buy?
Yeah, you could buy a lot, and now you can almost buy one. Yeah. So if you're spending $1980 today, you're in trouble. Same thing will probably happen going forward. So you want to have enough stocks or equity in your portfolio to still grow. You want some bonds in your portfolio to provide ballast, for down markets. And you also want some short-term instruments, mainly to buy yourself time, so that when we do have a downturn, you don't have to sell stocks. Because I think that's the other thing that we get tied up on is you say, okay, a retiree, because they have to sell their stocks to generate income, they can't take a bear market. Well, if you have a properly diversified portfolio, what you really do is you sell your short-term bonds and your cash during a bear market, and you just wait it out.
Yeah.
So it changes in retirement, but it doesn't change as much as we think it does,
right?
Because you still have a long time.
So looking at not necessarily from the day I retire everything changes, but still focusing on the average life expectancy for a female or male, and how am I going to live my life and spend that money. We've got 30 seconds, so I'm gonna ask you one final quick question. Just on the whole, as far as advice for people who are listening when it comes to retirement, in 30 seconds, what would you suggest to them?
Save more today, and you'll thank yourself tomorrow.
There you go. Okay, with that, we really appreciate you joining us here, Doug. That was great. Some very insightful stuff. And thank you to all our listeners. Please join us again for Money Sense. You can tweet us at Money Sense Radio. If you have any questions, please feel free, either for Doug or for us in the future, whether it's a topic question. We're happy to take your call and answer your questions with regards to financial advice. So thank you again for listening, and please join us in 2 weeks.